What if the silver price flashing on your screen right now has absolutely nothing to do with what the metal is actually worth? Not some fringe theory, not a hypothetical. It's a data-backed reality that's been building for months, exposed in full by the chaos we're seeing today. Hi, I am Roxanne. Here we don't sell courses, signals, or anything else, just the real data and what it means. If you're tuning in for the first time, this channel is all about cutting through the noise in precious metals markets. We don't cheerlead one side or the other. We look at macro trends, micro details, geopolitics, and raw numbers, even when they contradict popular narratives. And right now, with silver having just cratered 11% in a blistering 80-minute window, those numbers are screaming a story that goes way beyond a simple sell-off. This isn't just about a price drop. It's about a massive disconnect between paper markets and physical reality, amplified by a Middle East conflict that's rewriting global energy rules. Stick with me for the next 15 minutes, because every piece here builds on the last. Skip ahead and you'll miss the full picture, which in markets like this isn't just incomplete, it's dangerous. Let's start with what happened yesterday, March 3rd, 2026. Silver didn't just dip, it plunged between 10 and 11% in that 80-minute span before the New York Open, wiping out around $260 billion in market cap. Gold fell too, down about 2%, erasing roughly $740 billion. Combined, that's $1 trillion gone in under 2 hours across precious metals. The pace alone tells you this wasn't organic trading. Natural market reactions are choppy, uneven. Buyers step in, sellers hesitate. This was mechanical, precise, like a machine executing a program. And it happened against a backdrop that should have sent safe haven assets soaring. An escalating war in the Middle East with no end in sight, oil infrastructure under direct attack, energy supplies fracturing, and superpowers drawing clear lines. The US and Israel on one side, Iran backed by China on the other. So why did silver crash? On the surface, it's a textbook response to a supply shock. Algorithms scanned the headlines. US and Israeli strikes on Iran intensifying. Iraq shutting down the Rumaila field, the world's second largest, pumping 1.5 million barrels a day, about 30% of Iraq's output. Explosions at the UAE's Fujairah port, the key bypass around the Strait of Hormuz, and warnings of imminent Iranian attacks on Dhahran in Saudi Arabia, home to Saudi Aramco and the planet's biggest oil reserves. They interpreted it as a global growth killer. Factories slowing, manufacturing hubs grinding to a halt, a recession that dwarfs 2008. Silver, with 50% to 60% of its demand tied to industry, solar panels, EVs, electronics, AI servers, defense tech, gets repriced downward in a flash. Gold has no such industrial anchor, so it holds up better. The pecking order in these scares is always gold first, then silver, platinum, copper. The more tied to factories, the harder the hit until the growth fog clears. But an 11% nosedive crammed into 80 minutes? That's not macro logic. That's something else. Pull up the prices as of March 4th, 2026. Western spot silver around $82, futures at $82. Shanghai spot, closer to $101 in recent data, with premiums holding firm even after the crash. A 13% to 19% gap depending on the exchange. That's not a blip. It's a signal that physical metal in the East is trading worlds apart from Western paper contracts. The gold to silver ratio in paper markets sits at about 62 to 1 right now. Compare that to real-world benchmarks. The mining ratio, how much silver comes out of the ground per ounce of gold, is around 7 to 1. CME vault ratios hover at 11 to 1. LBMA vaults at 3 to 1 or higher. Above ground available supply? Roughly 1 to 1. One of these ratios is wildly out of sync with every physical and production metric. Math alone says it snaps back eventually. The only questions are when and how. Now layer in the fresh data from the Shanghai Gold Exchange. Their weekly report for February 24 to 27, 2026, silver inventory lines completely blanked out, zeroed across the board. Gold data? Reported in full, business as usual. This isn't a glitch. SGE has published detailed silver stocks every week without fail. Going dark now. During a historic price swing and active war, that's a choice. What are those numbers showing that they'd rather keep quiet? Physical stress was already flashing before the crash. Lease rates creeping higher over the past week, forward swaps turning negative. For the uninitiated, rising lease rates mean borrowing physical silver is getting pricier, a classic sign of tightening supply. Negative swaps signal backwardation risk, where spot delivery demands a premium over futures. Paper prices tank to $82. Physical indicators scream the opposite. Both can't be right. Over on the CME, the story echoes. On Friday, February 28, 2.8 million ounces were yanked from silver vaults in one day, pulled from Brinks, CNT, Delaware, and JP Morgan all at once. Dig deeper. Eligible silver, metal meeting specs but not yet registered for delivery, is dropping faster than registered stocks are rising. Net total inventory? Still declining. Headlines might spin a rising registered narrative, but the full data shows vaults draining. And on March 3rd, the Shanghai Futures Exchange suspended 5 groups of accounts for trading violations, right in the middle of that 11% move. Account freezes during a crash? Someone was gaming positions, and the exchange clamped down. 2 Chinese actions on the same day. Inventory blackout at SGE, suspensions at SHFE. Coincidence? Unlikely. This brings us to the manipulation angle. And it's not speculation, it's documented. Jane Street, the quant trading giant, became the largest holder of BlackRock's iShares Silver Trust, SLV, after scooping up 20.6 million shares in Q4 2025, a 500x jump from the prior quarter, worth about $1.3 billion and 3.6% of outstanding shares. Over 87% of their $662 billion portfolio? Options. Their model thrives on volatility. Build a big underlying position, layer massive derivatives on top, then move the price to cash in. Regulators in India nailed them for manipulating cash markets to profit on options. Terraform Labs sued over similar tactics in the $40 billion Terra crash. In crypto, there was the infamous 10 a.m. Eastern dump in Bitcoin. So predictable it had a name, until lawsuits forced it to stop. Patterns the same. Position, derivatives, price move, profit. And who custodies the physical silver backing Jane Street's SLV stake? JP Morgan fined nearly $1 billion for precious metals manipulation. When the holder and the custodian both have rap sheets, an 80-minute crash before New York opens looks engineered. X posts and trader chatter back this up. Accusations of Jane Street's high-frequency algos dumping futures, tanking spot, triggering stops, and cascading sales. One post called it the worst silver session since 1980, 31% intraday wipeout in spots, but data shows 11% to 19% drops. Point is, leveraged liquidation hit hard, not fundamentals. In a true liquidity crunch like yesterday's, US dollar up 1%, challenging January highs, DAX down 4%, NASDAQ futures off 2.5%, S&P futures down 2%, Korean Kospi crashing 7% on reopen, $270 billion gone. Correlations go to 1. Everything sells. Stocks, bonds, metals. Dollar rises, pressuring dollar-priced assets. Oil's the outlier, surging from $72 to $76 despite the rout, with Brent settling at 81, highest since January 2025. Because physical disruptions trump paper pressure. U.S. warnings of Iranian strikes on Saudi. Israel hinting at Saudi prepping to hit Iran. China formally opposing U.S.-Israeli action. Trump quoting, "We haven't even started. The big wave hasn't happened. It will come soon." 15 sites struck. Saudi's largest refinery offline. Qatar's LNG halted. This isn't contained. It's expanding. But here's the paradox the algorithms miss. This crisis isn't a recession pause, it's a forced pivot. Oil taps shut, energy demand doesn't vanish. It shifts to what's deployable fast, without Gulf pipelines. Solar's the answer for rapid rollout. Roofs, warehouses, fields in months, not years for nuclear or Arctic drilling. And high-efficiency solar needs silver. It's the most conductive metal, irreplaceable in top-tier panels despite thrift efforts. Global silver demand was already in deficit, consuming more than mined for 3 years, eating stockpiles. Now add wartime solar mandates for energy security. Hundreds of millions of ounces extra, hitting a market projecting 67 million ounce shortfalls for 2026 per Silver Institute. Supply? Mostly byproduct from base metals like copper, zinc. If recession slows those mines, silver output drops too. Perfect storm. Exploding demand, contracting supply. Paper markets price silver like a luxury in tough times. But in a post-oil war world, it's strategic, like uranium or lithium. Industrial buyers, First Solar, Samsung, defense firms, will demand delivery, ignoring COMEX spots at $82. When vaults empty, panic resets prices violently. Gold-silver ratio snaps back from 62. Individuals? This crash is opportunity amid apocalypse sentiment. Media screams commodities dead, economy crashing, stick to gold or cash. But they're eyeing yesterday's recession, not tomorrow's energy transition. From fossil fuels to photons, silver's the bridge. The honest bear case. Silver broke the 150 EMA on hourly near $90. Decisive technical fail. Liquidity squeezes liquidate even sound assets. Western miners lag Chinese ones, signaling weak commitment. Dollar breaking January highs? More headwinds. These risks are real. But unchanged, SGE dark on inventories at peak stress. 2.8 million ounces out of CME. Lease rates up, swaps negative. Paper ratio defies physical realities. Mining 7-1, vaults 11-1. Scottsdale Mint CEO, a public company adding unprecedented physical silver to treasury at these levels. Buyers aren't stopping, they're accelerating. Watch inventories, premiums, lease rates, not just the screen. Every data point here is verifiable. Check sources yourself. If this framework helps you see markets clearer, share it. Like if you're done with hype. Subscribe for what's coming in 2026, beyond metals. Drop Roxanne real data in comments if you're the type who verifies, thinks long-term. Logic over emotion. The data doesn't lie.